What happens when the Bank of England changes interest rates? When Bank of England announces an interest rate decision, news websites are filled with predictions about what it means for homeowners, buyers, and the economy. For many people, however, the reaction is often the same. Will my mortgage go up? Should I fix my rate now? Is this good news or bad news? The truth is that while interest rate changes can have a significant impact on mortgages, the effects aren't always immediate or straightforward. In this guide, we'll explain exactly what happens when the Bank of England changes interest rates and what it could mean for your finances. First things first, what is the base rate? The Bank of England base rate is the interest rate the bank charges other banks and financial institutions when they borrow money. Think of it as the foundation of the UK's financial system. When the base rate changes, it influences mortgage rates, savings rates, credit card rates, loans, business borrowing, consumer spending. The Bank of England uses interest rates as one of its main tools to control inflation and support economic stability. Why does the Bank of England change rates? The primary goal is to keep inflation under control. Inflation measures how quickly prices rise over time. When inflation is too high, the Bank of England may increase interest rates to slow spending and borrowing. Higher rates generally mean more expensive borrowing, lower consumer spending, reduced demand in the economy. This can help bring inflation back down. On the other hand, if economic growth is slowing and inflation is under control, the bank may reduce rates to encourage borrowing and spending. Lower rates typically mean cheaper borrowing, more spending, increased investments, greater economic activity. What happens to mortgage rates? This is the question most homeowners want answered. The effect depends on the type of mortgage you have. Tracker mortgages. Tracker mortgages are directly linked to the Bank of England base rate. If the base rate rises by 0.25%, your mortgage rate will usually increase by the same amount. If the base rate falls, your payments should reduce. The impact is often felt almost immediately. Standard variable rate, SVR, mortgages. If you're on your lender's standard variable rate, changes in the base rate often influence your mortgage rate. However, lenders are not obliged to pass on changes in full. Some may increase rates more than the base rate change, while others may choose not to pass on reductions immediately. Fixed rate mortgages. This is where many people become confused. If you're currently on a fixed rate mortgage, your monthly payment won't change during your fixed period. Whether the bank increases or decreases rates, your mortgage payment remains the same until your deal expires. However, future fixed rate mortgages can still be affected by market expectations. Why fixed mortgage rates don't always follow the base rate? One of the biggest misconceptions in the mortgage market is that fixed rates move directly with the Bank of England base rate. In reality, lenders often price fixed mortgages using something called SONIA swap rates. Swap rates reflect what financial markets expect interest rates to do in the future. This means fixed mortgage rates can sometimes rise even when the Bank of England cuts rates. Likewise, fixed rates can fall before the Bank of England announces a rate reduction if markets expect cuts to happen. This is why mortgage pricing can sometimes seem disconnected from the headlines. How does it affect house prices? Interest rates and house prices are closely linked. When mortgage rates are lower, borrowing becomes more affordable. Buyers can often borrow more. Demand for property increases. This can support house price growth. When rates rise, borrowing becomes more expensive. Affordability decreases, demand may slow. This can place downward pressure on house prices. However, property values are influenced by many other factors, including supply, employment levels, wages, and consumer confidence. What does it mean for first-time buyers? For first-time buyers, interest rate changes can affect both affordability and confidence. When rates fall, monthly mortgage payments may become more affordable. Borrowing potential can increase. More mortgage products often become available. When rates rise, affordability can become more challenging. Buyers may need larger deposits. Lenders may apply stricter affordability assessments. This is why obtaining an agreement in principle, AIP, remains one of the smartest first steps. An AIP helps establish exactly what you can borrow and allows you to move quickly when opportunities arise. What does it mean for existing homeowners? If you're already a homeowner, the impact depends on your current mortgage. Questions worth asking include, when does my fixed rate end? How much will my payments change if I move on to the lender's SVR? Should I review my mortgage before my current deal expires? Many borrowers can secure a new mortgage deal up to 6 months before their existing rate ends. Planning ahead can help avoid unpleasant surprises. One of the most important things to understand is that mortgage rates aren't driven solely by the Bank of England. Global events, inflation figures, government borrowing, swap rates, and investor confidence all play a role. That's why you may sometimes see the base rate falling while fixed mortgage rates rise, the base rate staying unchanged while lenders reduce rates, mortgage pricing moving before any official bank announcement. The market is constantly looking ahead. When the Bank of England changes interest rates, it affects much more than just mortgages. The decision influences borrowing costs, savings returns, business investment, house prices, and consumer confidence. For homeowners and buyers, understanding these changes can help you make better financial decisions and avoid reacting purely to headlines. The key is not trying to predict every move in the market, but making sure your mortgage remains suitable for your circumstances. At Cambs Ely Mortgages, we monitor lender pricing, swap rates, and market movements daily. With access to over 200 lenders, we can help you understand how interest rate changes affect your options and identify the most suitable mortgage for your circumstances. Whether you're buying your first home, moving, remortgaging, or simply reviewing your current mortgage, we're here to help. Cambs Ely Mortgages, building blocks for a brighter future.